On 10th of May, a previous LIC Monash Absolute Investment Company, ticker MA1, converted to an exchange-traded mutual fund structure and started to trade on ASX. It was the first LIC that changed the structure and joined the ETF rally. So in this video, I want to talk about what is a LIC and what are the differences between a LIC and an ETF, and what made MA1 to convert it to an ETF structure, and is LIC still a good investment for us? Actually, the last question, you should be able to have your own judgment after you see all the facts that I'm going to lay out in this video. Now, let's get started. Now, let's clear the terms first. What is a LIC? LIC stands for Listed Investment Company, and LIT stands for Listed Investment Trust. I'm going to call them LIC and LIT just for short in this video. Most LICs run like actively managed funds, which they have external and internal fund management teams to select and manage their investments, which could be stocks, bonds, properties, or even unlisted companies. By buying one share of a LIC, you are exposed to a portion of their investments. And do you know that LICs actually have long history way before the first ETF? It actually started 70 years earlier than the first US ETF and 78 years earlier than the first Aussie ETF. It used to be one of the best ways to gain diversification for investors through one trade. Fast forward until now, the asset under management of LICs and LITs are about 55 billion, and the asset under management of Australian ETFs are now about 107 billion. So what's going on here? Why the latest started ETFs are dominating the market and become so popular? To answer this question, we have to compare the major differences between LICs and ETFs, because at first glance, they do seem to have a lot of similarities. By the way, if you enjoy watching this video so far, please click the like button below, and I really appreciate it. First is their legal structure and tax a little bit different. And when you invest in a LIC, you actually own shares of that company rather than the underlying assets. While ETF is a trust. So when you invest in an ETF, you actually own the units in the fund. And because LIC essentially is a company who pays company tax, so normally their distributions are fully franked dividends, only when the board declares the dividends. But for ETFs, they must pass on all dividends to their unit holders, who will pay their tax on their own marginal tax rate. Let's look at their investment style. For LICs, most LICs are actually managing their investments, trying to outperform the market. And some LICs even use the arbitrage strategy or products like short selling or leverage or derivatives. While ETFs, the majority of the ETFs, they are passive index ETFs, but there are actually managed ETFs as well. And because most LICs are trying to outperform the market, so they generally charge a much higher fee because it relies on the expertise of the fund management team. So an average LIC charge about 5 times of a typical index ETF. And some LICs, not only they charge the management fee regardless of the performance, they also charge investment fee if they outperform the benchmark. But Spivot reports majority of active fund managers underperform their benchmark year after year. As of 31st December 2020, 81.7% of Aussie active managed funds underperform the ASX 200 index. Next is the fund structure, which is the most distinctive difference between a LIC and an ETF. While LICs are closed-ended funds, meaning the number of shares are fixed upon IPO, so the share price are highly driven by the investors' demand rather than the value of the underlying assets, which is represented as the net tangible assets, NTA. So this closed-ended fund feature actually determines that an investor who wants to sell a LIC needs to find a buyer who is willing to buy at a certain price. So this is okay if the LIC is trading at a premium above the NTA. But according to Morningstar, 80% of LICs trade at a discount to their NTA, and 45% of the discount is greater than 10%. This trading at a discount actually represents a liquidity issue that not enough buyers to offset the sellers, and also represents the bearish point of view from the shareholders of the LICs. And also the government banned the commission that pay to the financial advisors or the brokers to promote the sales of LICs in July last year. So that actually decrease the demand for the LICs as well. And LICs are fully aware of this discount issue, and actually it has been a big pain for them for years. And some funds even try off-market buyback or on-market buyback or larger dividend payout issues just to narrow the discount, but usually failed. This is actually exactly the reason why Monash Absolute Investment Company changed to an open-ended ETF structure, which allows the share price to be close to the net asset value, the NAV. This leads to the transparency difference. For LICs, they report portfolios and NTA monthly, while by the time they report it, it's probably out of date. And for ETFs, they update the net asset value, the NAV, every 30 seconds, just allows the share price to be traded near the NAV. So apparently ETFs are more transparent than the LIC. For any investment, I would like to compare for the returns and the costs as well. Let's roughly compare 3 famous LICs with Vanguard Australian Shares Index ETF VES without considering their fees. So I've got AFI, Australian Foundation Investment Company, and ARG, Argo Investment Listed, and MLT Milton. This graph only represents the share price point of view. If we take higher fees of LICs over ETFs, VAS is going to outperform even more. Do you have LICs in your portfolio, and do you think LICs are still good investments for everyday investors? Please leave your comment below. All right, that's the wrap for today. I'll see you next week. Bye.